Welcome back to On-Chain. I'm Marcus. Today we're talking about trading perpetuals on Monad, not from a theoretical standpoint but from the practical retail trader's perspective. If you're coming from a CEX background or you've been trading spot on-chain but haven't touched perps yet, this episode is specifically for you. To walk through how this actually works, I've got James from LeverUp, which is the main perps protocol running on Monad right now. James, good to have you.
Good to be here, Marcus.
Let me start with the blunt question. Why would someone who's been trading on Binance or OKX even consider moving that activity on-chain? What's the actual pitch to a retail trader?
The honest answer is that for most retail traders, CEX trading is perfectly fine for a lot of use cases. I'm not going to tell you the on-chain experience is better in every dimension. It's not. What it offers is different. Non-custodial execution, access to markets you can't get on a CEX, like Monad ecosystem token perps, and no KYC requirements for most users depending on jurisdiction. The more interesting question for someone who's already engaged in the Monad ecosystem is, what do you do with capital you're already holding on-chain? If you want to trade perps without pulling assets back to a CEX, bridging, going through KYC, and then bridging back, that's where the on-chain case becomes practically compelling.
Fair enough. So given that context, what specifically does Monad change about the on-chain trading experience? Because I've tried trading perps on Ethereum L1 and some older L2s, and the experience was frustrating. Transactions queuing, stale prices, gas fees eating into small positions.
Those frictions are real, and a lot of them trace back to block time and throughput. When blocks are slow, Oracle prices can lag meaningfully behind real market conditions. The reference price that the protocol uses for margin calculations and liquidation checks can be minutes old in a fast-moving market. That's a genuine problem. Monad's sub-second block times can help reduce that pricing latency and stale pricing risk throughout a position's lifecycle, from entry through to liquidation checks. That's not a guarantee, it's dependent on network and Oracle conditions, but it's a structural improvement over higher latency chains.
And does that actually change the liquidation picture? I've heard traders complain they got liquidated at prices that didn't match what they saw on the chart.
That's the stale pricing problem in practice. Your position's liquidation threshold is calculated against a mark price derived from Oracle data. If that Oracle data is lagging a fast market, you can get liquidated against a reference price that's already moved significantly from where spot is. Fresher Oracle data means the mark price used for those checks is more likely to reflect actual market conditions at that moment. Lower Oracle staleness doesn't eliminate liquidation risk. Your position can still get taken out if the market moves against you, but it reduces the scenario where you're liquidated against a price that's materially different from what you're seeing on screen.
Let's talk about transaction costs for small accounts, because I think this is something that doesn't get discussed enough. If I'm trading with a $200 account, what does the economics look like on Monad versus Ethereum mainnet?
The economics shift meaningfully. On Ethereum mainnet, a single perp trade can cost several dollars in gas, sometimes significantly more during congestion. At that cost structure, a $200 position is already fighting an uphill battle. You need a fairly large percentage move just to cover round-trip transaction costs before any profit. Monad is designed to offer much lower transaction costs than Ethereum mainnet. The exact break-even depends on the position size, the market, current network fee rates. I'm not going to give you a precise number because it varies, but the structural point is that the cost-to-position size ratio is much more favorable for smaller accounts. A position that would have been economically non-viable on mainnet becomes viable.
That's a real change in who can participate. What about execution consistency? The stale Oracle stuff we covered is one thing, but what about transactions landing in the right order, front-running, that kind of thing?
Monad's execution design may reduce some congestion-related ordering issues compared to higher latency chains. That's a meaningful word, may. I want to be honest about the limits here. On-chain execution is never fully deterministic, and ordering dynamics on any chain are complex. What I can say is that a high-throughput, lower latency environment structurally creates fewer opportunities for congestion to become a meaningful source of execution degradation. Beyond that, the specifics depend on network conditions at any given moment.
Reasonable caveat. You're not promising anything you can't deliver. Let me ask the natural follow-up. If these are chain-level properties that any protocol on Monad gets, what specifically does LeverUp add on top?
The chain is the foundation. What LeverUp builds on top of it is a different approach to market structure. Most DeFi perp protocols are built on a shared liquidity pool model. External LPs deposit funds, and those funds form the capital base against which trading positions settle. The protocol's risk parameters, position size limits, market access, all of these are calibrated around protecting that LP pool's solvency. When LP capital is thin, especially on a new chain that can create real constraints quickly, LeverUp uses a protocol-managed virtual liquidity system powered by the VMMV. Trades reference Oracle pricing, and execution, settlement, and risk management are all handled at the protocol layer rather than by an externally supplied LP pool.
Okay, help me understand the practical consequence of that for someone sitting at their trading terminal. What actually changes?
A few things that matter directly. First, open interest capacity scales with protocol risk parameters rather than with the size of an externally supplied LP pool. In a pool-based model on a new chain, you can hit capacity constraints quickly because LP capital hasn't had time to accumulate. In LeverUp's architecture, that ceiling is governed by risk parameters rather than by how much capital LPs have decided to deposit. Second, protocol value flows back into the trader ecosystem rather than flowing primarily to an external LP pool. The fee model is documented transparently. The routing of that value goes through staking and buyback mechanisms rather than out to an external capital provider.
Let me push on that second point. Protocol value flows back into the trader ecosystem. I hear variations of that phrase a lot, and it often means very little in practice. What's the actual mechanism?
It's fair to be skeptical of that framing without the specifics. The mechanism is that fees generated by trading activity on LeverUp are routed through the protocol's economic design, LVMON staking, and the LV buyback program, rather than being distributed to external LPs. So the capital that would otherwise leave the ecosystem to pay LP yield stays within the LeverUp protocol's economic structure. If you're staking LVMON or holding LV, you participate in that. If you're just a trader with no protocol stake, the direct impact to you is less obvious.
And the third consequence, execution responsibility.
In a pool-based model, external LPs are managing their own inventory and market exposure independently. In LeverUp's architecture, execution and settlement responsibility sits at the protocol layer. That doesn't mean the protocol takes on unlimited risk. It means the risk engine is operating from a defined rule set at the protocol level rather than being influenced by individual LP behavior.
Let's move to AnyCollateral, because I think for Monad ecosystem participants this might be the most immediately practical feature. What is it, and why does it matter?
The simple version, supported Monad ecosystem tokens, can be deposited as trading margin on LeverUp without selling them first. The context that makes it matter: if you're holding a Monad ecosystem token, something you're genuinely bullish on, and you want to open a perp position on BTC or gold or an equity index, the standard path is sell the token, get stablecoins, then trade. You've exited the position you wanted to keep in order to enter a new one. Capital inefficiency, realized tax event, missed upside on the sold token if it runs while you're in the trade. With AnyCollateral, you deposit the supported token as collateral. It's locked, not sold, and you open your position using that as margin. The token exposure stays intact.
Walk me through the mechanics. How does the collateral ratio work?
Each supported token carries a collateral ratio, CR, that reflects its liquidity depth and volatility profile. A token with a CR of 70% means that for every dollar of that token you deposit, you get 70 cents of effective margin for trading. The CR isn't arbitrary, it's risk-calibrated. A highly liquid, well-established token earns a higher CR. A newer or more volatile token sits lower. The ratio protects against the scenario where a rapid drop in the collateral token's value undermines the margin backing an open position.
Okay, and this is where I want to make sure we're clear on the risk side, because I think some traders will hear, use your Monad tokens as margin, and assume it's just pure upside. What's the risk they need to understand?
This is the most important part of the AnyCollateral conversation, and I'm glad you're pushing on it. Every AnyCollateral position carries dual liquidation risk. There are two independent vectors that can trigger liquidation. The first is the perp market itself. The trade goes against you, standard. The second is your collateral token's price movement. If the token you deposited drops sharply while you're in a trade, your effective margin shrinks independent of how the trade is performing.
Meaning I could have a profitable trade and still get liquidated.
Exactly. If your collateral token drops far enough to push your effective margin below the liquidation threshold, the position closes even if the trade direction is profitable. Both vectors operate simultaneously and independently. The position sizing logic changes as a result. When you're using volatile ecosystem tokens as collateral, you need to build in headroom for collateral drawdown, not just for the trade's own risk. People who don't account for that can find themselves in a situation they didn't anticipate.
That's an important distinction from standard stablecoin margin perps. Read the documentation before you use this feature. I'll say it even if James is too diplomatic to.
No, that's exactly right. The LeverUp documentation covers this. I'd specifically point people to the risk section before their first AnyCollateral position. The mechanics aren't complicated, but understanding dual liquidation risk before you're in a live trade is much better than discovering it after.
Let's run through the markets available. Beyond the obvious BTC and ETH, what's actually on offer?
Three categories: crypto perpetuals, BTC, ETH, SOL, other major assets, up to 1001x leverage on the most liquid pairs. That's the core product. RWA perpetuals, gold, silver, major equity indices, including what's structured as a Magnificent Seven basket. These run on Oracle-referenced pricing with leverage parameters calibrated to the underlying asset's risk profile. The fee structure on RWA pairs is 2 basis points, which reflects their different market dynamics compared to crypto. And Monad ecosystem token markets, long and short exposure on Monad native tokens, which combines with the AnyCollateral program for collateral flexibility.
The RWA markets are the ones that feel most unusual for a DeFi context. Gold and US equity indices on-chain, no KYC, no brokerage account. How does that actually work from the exposure standpoint?
The positions are perpetual contracts that reference Oracle pricing for the underlying asset, gold spot, index prices. LeverUp doesn't custody gold or hold equity positions. The exposure is entirely through the contract structure referencing Oracle data. The practical implication for the trader is that you can express a directional view on gold or a technology equity basket using on-chain capital. Subject to applicable regional restrictions, Oracle availability windows, and the market's LeverUp supports at any given time, those are real caveats, not just boilerplate. Check what's currently live before you plan a position around it.
Leverage up to 1001x on some pairs. That number gets attention. What should retail traders actually do with it?
Most experienced traders are running well below that level in practice. The 1001x figure exists for very specific short-term intraday setups where someone wants maximum directional exposure for a very brief window. The practical framing, at 100x, an adverse move of roughly 1% can approach the liquidation threshold, depending on margin parameters, fees, and funding. At 1001x, the liquidation distance is measured in fractions of a percent. Those leverage levels don't forgive being wrong for 30 seconds. For someone new to perps, the range I'd suggest is 2 to 10 times. That gives you meaningful leverage without sitting directly on top of your liquidation price from the moment the trade opens. The 1001x exists, so does a liquidation price that is visible in the order preview before you confirm. Check it.
Funding rates. How does LeverUp's model work and what should traders watch?
Funding rates in perpetuals are the ongoing cost or income of holding a position, paid between longs and shorts to keep the perpetual price anchored to spot. If longs are heavily crowded relative to shorts, longs pay shorts to compensate for that imbalance. LeverUp's funding rate model scales nonlinearly with open interest imbalance. That means a heavily crowded side pays substantially more than a balanced market. The cost of being in a crowded trade ramps up quickly. The practical advice: check the current funding rate before holding any position beyond a few hours. For short-term intraday trades, it's a minor factor. For multi-day holds on a crowded market, it can become a meaningful drag.
So it's not just a flat fee. It's dynamic based on how the market is positioned.
Correct, it's a signal about market positioning as much as it is a cost. If you're paying high funding on a long position, that's telling you the market is significantly long-heavy at that moment. That's information worth having independent of what it costs you.
Let me close with the practical question. If I'm a Monad ecosystem participant who's been trading spot and I want to start with perps on LeverUp, where do I actually begin?
3 sequential steps. First, get assets onto Monad. LeverUp runs on Monad, so if you're coming from Ethereum, Arbitrum, Solana, or a CEX, you need to bridge USDC to Monad. The recommended tool is MonadBridge, MonadBridge.com, which supports bridging from most major chains via wormhole. Second, connect your wallet to LeverUp at app. LeverUp, Zeiss, Rabby, and MetaMask both work. Make sure your wallet is set to the Monad network before you connect. Third, open your first position. Pick a market, choose direction, set leverage and size, review the liquidation price and fees in the order summary, and before you confirm, set a stop loss. Don't open a leveraged position without a stop loss in place.
Any parting advice for someone who's genuinely new to perps and is about to open their first position?
2 things. 1. The liquidation price is displayed in the order preview before you confirm. Look at it. Decide whether you're comfortable with where it sits relative to current price. If it feels close, reduce your leverage. 2. AnyCollateral is compelling if you're already holding Monad ecosystem tokens, but understand the dual liquidation risk before you use it. Read the documentation first, specifically the risk section. The mechanics are manageable, but they require a different position sizing approach than stablecoin margin trades.
That's the honest retail brief on trading on Monad. James, this was genuinely useful, the risk framing especially. Thanks for walking through it straight.
Thanks for the sharp questions, Marcus.
That's a wrap. If you want to read everything we covered in more depth, the full retail guide is linked in the show notes. The article is called Trading on Monad: What Retail Traders Need to Know, published on the LeverUp blog. If you're ready to trade, app, LeverUp, Zeiss, Bridge Guide, AnyCollateral documentation, funding rate mechanics, all linked in the description. Subscribe wherever you get your podcasts. Back next week.